Hello everyone, welcome to EduTap and welcome to the final 360-degree sessions in which we cover the relevant RBI notifications and the finance current affairs which are important from your examination perspective. And today I have brought for you the two very important updates that the Securities and Exchange Board of India has suggested. So the first update is regarding the certification for the AIF managers, and the second update is regarding the SEBI that has allowed the AIFs to pledge their shares. So what is the meaning of both of these news articles? And let me tell you that this is not only relevant for the SEBI Grade A examination, but this is also relevant for the RBI Grade B examination, because in the phase 1 as well as in the phase 2 of the RBI Grade B, we have seen that there were basic questions from the SEBI. Okay, so we will discuss these both news articles from the examination point of view. They are very important from the objective point of view for the SEBI Grade A, for the RBI Grade B. Okay, so let's understand these both news articles in a very easy manner. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, as well as join our Telegram channel so that you can get the PDF of this session. So the link of the Telegram channel is provided in the description box below. So let's get started with the first news article, that there is the requirement of certification for key investment team of manager of AIF. So AIF is the alternative investment fund. So AIF is the alternative investment fund, that is a fund that is established or incorporated in India, which is a privately pooled investment vehicle. So what is happening, that the pooling of the money is happening from different investors. So from different investors the money is taken. So you will say that this is same as mutual fund. In the mutual fund also, from the different investors, from the retail investors, from the institutional investors, the money is pooled. But alternative investment fund is slightly different. The different investors are pooling in the money, but these investors are the sophisticated investors, and this is a privately pooled investment. Okay, so AIF, this is the alternate investment fund where the retail and the small investors are not so much engaged, okay, as much as the big sophisticated investors, they are engaged in this AIF. So AIF is incorporated or established in India, which is a privately pooled investment vehicle which collects fund from the sophisticated investors, whether Indian or foreign, for investing it in accordance with the defined investment policy. So simply AIF are collecting the funds from the sophisticated, from the big investors, and then they are putting the investment, then they are using this money for different kind of investments. Okay, so this is the alternative investment fund. Now it has been said by the Securities and Exchange Board of India, by SEBI, it has been said that there is the requirement of at least one personnel within the investment team. So this pooling of the money is happening, then this money is getting invested. So this money is getting invested by the investment team. So they are giving the idea that okay, we should invest in the shares of this particular company, we should invest in the bonds of this particular company. So what is happening, that this investment team is the one that is leading the investments. Okay, so this investment team, it has been said by SEBI that at least one person from this investment team should have the relevant certification. So what is that relevant certification? That is at least one key personnel amongst the associated persons functioning in the key investment team. So whoever is working in the key investment team, at least one of those should have the certification from the National Institute of Securities Market. Okay, so if you want to teach, you have to get the B.Ed certificate or B.Ed degree. If you want to teach in the institutions, in the universities, you have to clear the UGC NET examination, you need to have that certificate. So similarly, if there is the AIF, that is the alternative investment fund, that needs to get registered now. So for them, there is a requirement in the investment team of at least one person that should have the National Institute of Securities Market certification. So certification has to be taken from this particular institute by passing the NISM series 19C. Alternative Investment Fund Manager Certification Exam. So a certification exam has to be cleared to get a certificate from the NISM. So that is the basic idea. Okay. So as per the SEBI circular that was dated May 13. So May 13 there was a circular of SEBI that was released. So the investment team of the manager of the AIF. So whoever is managing that AIF, they have an investment team. So at least one person from that investment team should have the relevant certification from the NISM that they will get by clearing this particular examination. That I hope is clear. So this certification is very important for getting the registration now. So this is an eligibility criteria that at least one person from the investment team should have the certificate. This has become the eligibility criteria for obtaining the certificate of registration as an AIF. So simply, what is the idea now? That if you want to become an AIF, your investment team, at least one person from that investment team should have cleared this particular exam, and should have got the certificate from the NISM, that is the National Institute of Securities Market. Okay, so the requirement for at least one key personnel of the key investment team of manager obtaining the certification shall be applicable as an eligibility criteria to all the applications that the SEBI has got after May 10, 2024. So after May 10, 2024, whatever applications the SEBI is getting, so this has become an eligibility criteria. But what about the previous AIFs? They are already established and they do not have this kind of certificate in their team. So what will happen to them? So the requirement of obtaining the certification needs to be complied with on or before May 9, 2025. So nearly a year of the time has been given to the existing schemes of AIFs and the schemes of AIFs whose application for launch of scheme was pending with SEBI as on May 10, 2024. So anyone that has sent the registration before May 10, 2024 or that is already a scheme that is working, so they have got the time till May 9, 2025 to have in their team, in the investment team, to have at least one person that has the relevant certificate from the NISM. Remember the examination number also. This is the examination number that the SEBI has given. Okay, so this was quite a news. That's why I have brought it for you. So the new AIF, if you want to establish a new AIF, after the May 10, 2024, you are sending the application to the SEBI, then you will require in your team at least one person that has the relevant certificate. But if you are a previous scheme or if you are a previous AIF or if you have given your application before 10th May 2024, then you will get the time period till May 9, 2025 to have in your team at least one person that is having the relevant certificate. Very easy to understand. I hope everything is clear now. Any confusion, anyone? So now coming to the next news article. So this is a little difficult, or we can say this is a little of a higher level. So try to understand it very clearly. Okay. So what has happened that to facilitate the ease of doing business, see, it is mainly to boost the infrastructure sector, to boost the infrastructure sector. So to boost the infrastructure sector, the SEBI has taken a major decision. SEBI has taken a major decision. So what is that major decision that we are going to discuss? So this is to boost the infrastructure sector. Whatever I will be saying in this news article, remember this point in your mind that SEBI is doing this to boost the infrastructure sector. Now only one student has understood the idea. What about the other? Sorish and Shalini have understood the previous news article. What about the others? Is there any confusion? Because I will be able to move forward when you have understood the previous one, right? So give me a thumbs up very fast. Or you people are not able to understand the thing in the first news article. Got it? Very good, Ajay. What about the others? Give me a thumbs up very fast so that I can move forward. Okay, Lalit. Thank you for your clearance. Very good. Next. Okay. So let's start with the next news article, that is SEBI, that is the Securities and Exchange Board of India, has taken a major decision and has provided a framework for the category 1 and category 2 AIFs to create encumbrance on their holding of equity of investee companies. So majorly this is the idea that we will be discussing about. A framework has been provided by the SEBI. A framework has been provided by the SEBI for category 1 and category 2 AIFs. Okay. So let's focus on this now. To facilitate the ease of doing business and markets regulator SEBI. So to facilitate the ease of doing business, the SEBI, the Securities and Exchange Board of India, has allowed the AIFs in the category 1 and category 2 AIFs to pledge their shares in investee companies in the infrastructure sector. So what is the meaning of this? It is a little typical that we will understand. But before that, let's understand that what is this category 1 and category 2 AIFs. So we have understood that AIF, it is a privately pooled investment vehicle which collects funds from the sophisticated investors, and then they invest the money in different securities or in different areas. So there are different kind of AIFs. The category 1 AIFs are like the venture funds. They are the venture capital funds that are investing in the startups, that are investing in the small businesses so that they can gain the profits when that business expands. As well as there are the SME funds, that is the small and medium enterprises funds, that is providing the funds to the small and medium enterprises. There is the social venture funds, infrastructure funds and such. So AIFs, category 1 AIFs are such alternative investment fund which are investing in the startup or early stage ventures or social ventures or the small and medium enterprises or the infrastructure or other sectors or areas. So category 1 AIFs are working in multiple areas such as the startups, social sector as well as in the infrastructure sector and such. The category 2 AIFs, the category 2 alternative investment funds, they are working in the area of real estate. So real estate funds, the private equity funds as well as the funds for distressed assets. So they come under the category 2 AIFs. So the alternative investment funds that are investing in the real estate, they are investing in the private equity or the funds for distressed assets. So they are the category 2 AIFs. They are collecting the funds, they are pooling in the funds so that they can invest it in these areas. Category 3 AIFs are the hedge funds and such. They are complicated kind of funds that are investing in multiple areas and they are investing it in multiple securities also. Okay, so that is the basic idea. So these are the different kind of AIFs. This framework has been released for the category 1 and category 2 AIF, because here you can understand that category 1 AIF is directly related to the infrastructure sector and category 2 AIF, it is investing in the private equity. It is investing in the shares of different companies and shares of infrastructure sector also, you can understand that. Okay, so now coming to the details. So to provide ease of doing business and flexibility to the category 1 and category 2 AIFs to create encumbrance. So encumbrance means what? It is simply that AIF, they have pooled in the money. Now they are investing. The category 1 AIF and the category 2 AIF, let's say they are investing in the shares of, they are investing in the equity of the infrastructure companies. So these, let's say 5% of the shares of the this particular XYZ infrastructure company is with this particular AIF, Let's say it is number one AIF. Okay, so the 5% of the shares or equity of the XYZ infrastructure company is with this number 1 AIF. Now this AIF can pool in this shares or equity, that is the 5% of the shares and equity can be pooled in and can be converted into a encumbrance. Okay, so this encumbrance is what? It is that we are pledging this security for the investee company so that the investee company can take the loan against this collateral. So encumbrance, it is a legal claim. So AIF is having the legal claim on these shares or on this equity. So this is encumbrance is a legal claim on assets which are used. Now these shares or equity are being used as a collateral so that the investee company, that is the XYZ company. Investee company means that the company, investee company means this is the company of which the shares have been bought, and now this company is in the requirement of loan. So the AIF is saying that okay, whatever shares we have bought, they are property now, but we will let you use it as a collateral. We will let this company use these shares as the collateral, okay, against a particular fees. So encumbrance means this is a legal claim on assets which are used as collateral to secure a loan, and this loan is being taken by the investee company. Investee company is the company in which the investment has actually happened. So simply the idea is that this particular AIF has invested in the shares or in the equity of this XYZ company, that is an infrastructure company that is working in the infrastructure sector. Now this infrastructure company requires a loan. Now it is going to the bank to take a loan. So the bank will say that give us collateral. Now the infrastructure company has limited collateral. It is not a very big company. So the AIF will say that okay, this shares or equity that we have bought from you, that the AIF has bought from the infrastructure company, let us give this shares or equity. Let us make a encumbrance of this share or equity, that is, let us give us this share or equity as a collateral to the bank. So this is the basic idea. So this has been approved by the SEBI that okay, this can happen only for infrastructure companies, only for the boosting of the infrastructure sector, only for the boost in the infrastructure activities. Okay, so this has been allowed by the SEBI for the category 1 and category 2 AIFs, that the AIFs can use the shares or equity that they have bought. They can provide this as collateral for the investee company. Investee company is the company on which the AIF has invested in. That is the basic idea. Okay, so I hope this is clear. As you go forward, it will become more and more clear. So to provide ease of doing business and flexibility to category 1 and category 2 AIFs, to create encumbrance to pledge their securities as a collateral for the investee companies. Simply the idea is this. Okay, so in the context of AIFs, encumbrance on shares allow the AIFs to pledge their shares of investee companies for the loan that has to be taken by the investee company. We will slowly let's move ahead. Do not worry about it, Lucifer. Okay, so on their holding, so category 1 and category 2 AIFs can create the encumbrance on their holding of equity in the investee company. So whatever they have invested in the investee company, the equity, the shares that they have bought of the investee company, that can be used as a collateral to facilitate raising of debt by such investee company, so that this investee company can raise the loan, can raise the fund. Okay, so this is the basic idea. So this has been said by SEBI. Now accordingly, in terms of provisions of this particular, so these are the provisions. It has been said simply that the category 1 and category 2 alternative investment funds may create encumbrance, that is, they can pledge their shares that they have bought for the as the collateral for the investee company. Okay, now encumbrance can be created on equity of investee company which is in the business of development, operation or management of infrastructure projects. And which infrastructure projects? Can we say any infrastructure project that you are making a building? So that is an infrastructure project. So let's allow this particular company to have all the benefit. No, infrastructure projects in any of the infrastructure subsectors that is listed in the harmonized master list of infrastructure issued by the central government. That is, AIF can pledge their shares, can pledge their equity for the infrastructure company that is engaged in the development, operation or management of infrastructure projects that have been specified, that have been listed in the central government's list. So I hope this is clear that only those, for those infrastructure projects, only for those investee companies, that are engaged in the development, operation or management of infrastructure projects that are listed in the harmonized master list of the central government. I hope this is clear. So that is not any infrastructure projects, those infrastructure projects that are mentioned by the central government. So this is the idea, and not for the reconstruction or something. It is for the development, operation or management of the infrastructure projects that are listed in the central government's list. Okay, only for the purpose of borrowing and encumbrance can be created, the pledging of the shares can happen only for borrowing by such investee company and subject to such conditions as may be specified by the board of the AIF from time to time. So that is the basic idea, that only for the borrowing by the infrastructure company, the collateral can be created by the, collateral can be provided by the AIF. So that is the idea. And this infrastructure company should be engaged in the infrastructure project that is listed in the list of the central government. So that is the idea. Okay. Now conditions, there are some conditions that have been specified by SEBI. So existing schemes of category 1 or category 2 AIFs who have not onboarded any investors prior to April 25, 2024. So the circular was released on 26th. So it has been said that if you have not onboarded any investor prior to April 25, 2024, may create encumbrance. They can create encumbrance. And they can allow, they can do the pledge of their shares. They can pledge their shares as a collateral for this investee company that has invested in the infrastructure project that is listed by the central government. Okay. Now, subject to explicit disclosure that the investors that are getting in the scheme, the investors that are being, they are providing. So the investors that are providing their funds, for this particular AIF. So it has to be told to all the investors that what is going to happen, that we have pledged the shares as a collateral, so that the investors are aware about their risk and the investors can also demand higher profits. That okay, we are taking higher risk, so give us higher profits. You are getting some fees from the company also, no? So give us more profits also. So the investors should be made clear about this particular idea that we are pledging the shares as a collateral for the investee company, and the investee company, yes, it can default. Okay. Subject to explicit disclosure with respect to creation of such encumbrance in this regard, and disclosure should happen of the associated risk in their private placement memorandums. Like when you are getting a loan, you get the key fact statement where all the fees are written, that what is going to be the annual interest rate, what is going to be the annualized percentage, and so. So like when you are getting a loan, you get the key fact statement. Similarly, when you are investing in an alternative investment fund, you get a private placement memorandum where all the risks are written, all the profits are written. Okay. So this should be, all the disclosures have to happen in this PPM. Any encumbrances, and remember that the encumbrance can only be created for this kind of project. Very specifically, the SEBI has cleared it that encumbrances can only be created for the investee company that is engaged in the infrastructure projects that are listed by the central government. Okay, so remember this. So whenever here they specified above, that means encumbrances that can be created only for the infrastructure projects that are listed by the central government. Okay. So any encumbrances already created by a scheme of category 1 or category 2 AIF prior to April 2024. So encumbrance, if it has already been created prior to 25 April 2024 on the securities of investee company for the purpose of borrowing of such investee company may continue if such encumbrances were created after making the explicit disclosures in the PPM. So it has been said that if you are enrolling new investors, make the explicit disclosure, tell everything, all the risk, all the profits, tell it in the private placement memorandum. If there is the before April 25, 2024, if there were some encumbrances that were created, so the investors, if they are already made aware about the risk, if already in the PPM everything has been made clear, so it is fine. Okay. Next is, in case such encumbrances were created by a scheme of category 1 or category 2 AIF without making an explicit disclosure in the PPM. That means investors might not be clearly aware about such kind of encumbrances that are created. So such encumbrances may continue with only if the encumbrances were created on securities of investment company as specified above. So investee company is what? Investee company is the infrastructure company that is engaged in the infrastructure project that is listed by the central government. So if the encumbrances are created on the shares on the equity of investee company as stated above, and consent of all the investors have been taken, that all the investors are fine with it, they are getting more profit, so they are happy with it, they do not have any problem even with the higher risk. So consent of all the investors has to be taken in the scheme of the AIF latest by October 24, 2024. So remember the date, latest by October 24, 2024. If you have already not disclosed that you have created the encumbrance, if the AIF has not disclosed it in the PPM, then they have to take the personalized acceptance from all the investors by October 24, 2024. Okay, and if all the investors are not agreeing, then you have to stop those encumbrances latest by January 24, 2025. So if consent of all the investors is not obtained within the aforesaid time period, the encumbrances shall be removed latest by January 24, 2025. Such encumbrances may not be continued with if the encumbrances were created on securities that are not permitted by the central government, that are not in the list of the central government. As easy as that. So we have understood this criteria, right? That the investee company that is engaged in the infrastructure projects, that is listed in the central government list. So if such encumbrances are not created that are for this particular purpose, then such encumbrances have to be removed by October 24, 2024. So such encumbrance may not be continued with if the encumbrances were created on securities of investee company that is other than the one listed above. So if the encumbrances are being created not for this, if the encumbrances are created not for this kind of investee company that is engaged in the infrastructure project for this particular idea. So if the encumbrances are not created for this particular purpose, then those encumbrances you have to stop it. Okay, anyway you have to stop that. Okay, so this is the basic idea. Now category 1 or category 2 AIFs shall ensure that the borrowing that has been made by the investee company. So now investee company is borrowing and you are providing your shares, you are pledging your shares as collateral. So you have to see that where the borrowing is happening, why that borrowing is happening. Okay, so category 1 or category 2 AIF shall ensure that the borrowing made by the investee company against the equity investment encumbered by the AIF are utilized only for the purpose of development, operation or management of the infrastructure projects that have been specified in the list of the central government. So that is the idea, that you have to see that why the borrowing is happening. The borrowing is happening for the right purposes or not. Okay, and the aforesaid limitation on usage of borrowing shall be included and one of the terms of the investment agreement. So you have to mention it in your term and condition also, that if the borrowing will happen and if we are encumbering, if we are pledging the shares that we have purchased, then you have to use it only for the aforesaid reasons, only for the development, operation and management of the infrastructure projects. Okay. Next is that usually the alternative investment fund, they have a lock-in period. Let's say the lock-in period is of 3 years. Then the collateral can only be provided for the 3 years. So that is the idea. The duration of encumbrance created on the equity investment shall not be greater than the residual tenure of the scheme. So if the AIF is for the 3 years, if the scheme is for 3 years, then the encumbrance can only be for 3 years. Okay, even if the loan is for 10 years, the company has to bring in some new collateral after the 3 years. So that is the idea. Any category 1 or category 2 AIF with more than 50% of foreign investment or with foreign sponsor or manager or with persons other than resident Indian citizens as external members in investment committee, which is set up to approve its decision, shall ensure compliance with RBI master direction, and this particular AIF will be considered as a person resident outside India. So if it has more than 50% of foreign investment or foreign investors are included here, foreign sponsors are included here, so RBI directions have to be followed here. Okay, so that is the idea. In case of default, so now coming to the question that was asked by Lucifer, that what if the default happens? So yes, if default happens, this is the risk, right, of creating the collateral, that what if the default happens? So this is the risk that is being taken by the AIF, but you are earning higher profits, so you have to take higher risk also. So in case of default by the borrower, investee company, so investee company, XYZ company is the investee company that has done the borrowing. So category 1 or category 2 AIF shall ensure that the fund or its investors are not subject to any liability over and above the equity. Okay, so the collateral was given by the AIF, that was the 5% of the shares that was bought by the AIF of this company. So this much is the liability of AIF. This much is the liability of AIF, not more than this. So this is what the SEBI has said, that in case of default is being done by this XYZ company, is done by the borrower, then the category 1 or the category 2 AIF shall ensure that the fund, the scheme, the AIF as well as its investors, they are not subject to any liability over and above the equity of the borrower investee company that was encumbered by the AIF, that was pledged by the AIF. So no extra interest has to be paid, no extra thing has to be paid. This was the collateral that you provided. So this is the only responsibility that you should be taking. So that is the basic idea. The aforesaid flexibility of creating encumbrance or in equity investment shall not be interpreted as allowing schemes of category 1 and category 2 AIFs to extend any form of guarantee. So only the guarantee, only the collateral that has been mentioned in this circular, only that should be the idea. No extra guarantee can be provided by the category 1 or category 2 AIFs. Schemes of category 1 or category 2 AIF shall not create encumbrance on their investments in foreign investee companies. So remember this also. It is only for the Indian infrastructure sector, only for the Indian companies. So last point from this circular is that the pilot standard setting forum for AIFs, that is the SFA, standard setting forum for the AIFs, in consultation with SEBI, shall formulate the implementation standards to ensure that the encumbrance are created in the right direction and for the right companies. So there should be some standards that have to be followed by the AIFs. Okay. Such standards shall be published on the website of the industry associations which are part of the FSA, that is, you can read the name of the other segments. Okay. Now the circular is issued by the SEBI in exercise of the powers that is given to SEBI under section 11(1) of the SEBI Act of 1992 to protect the interest of the investors. This has been taken. This decision has been taken. So this is it for today. Now Sorish and some students had asked me regarding the interest rate parity. So let me tell you a brief about this interest rate parity. But before that, can you all tell me that everything is clear or there is some confusion? Everything is clear? Give me a thumbs up if everything is clear. See, interest rate parity, it is the difference between the forward exchange rate and the spot exchange rate is equal to the difference between the interest rate of one country with the other country. Okay. So that is the forward exchange rate between the two countries and the spot exchange rate between the two countries. The difference between the forward exchange rate and spot exchange rate between the two countries is equal to the difference between the interest rate of the two countries. So this is actually the formula. So you can understand that, let's say that the interest rate in US is 2%, interest rate in France is 3%. So this is the 1% is the difference between the interest rate. So US has the interest rate of 2%, the France has the interest rate of 3%. So there is the difference of interest rate, that is 1%. Now this difference should be equal to the forward exchange rate of US and France minus the spot exchange rate of US and France. Okay, so that is the forward exchange rate. The spot exchange rate of US against France is 1.13. That you have to give 1.13 US dollars to get 1 franc. So that is the spot exchange rate. Dollars against euro. So it is for the European Union currency, or for the franc also we can consider. Okay. So here this is the example that interest rate is 2%, that is 0.02 of US, 0.03 in the France. Okay. And the spot exchange rate is 1.13. So you are getting the forward exchange rate as 1.12. So you can understand that the difference between the forward exchange rate and the spot exchange rate, this is equal to the difference between the interest rate in one country and the interest rate in the other country. So the difference between the interest rate in the two countries is 1%. So the difference between the forward exchange rate and the spot exchange rate is also 1%. So the spot exchange rate was 1.13. Okay, deduct 1%, that is 0.01. So deduct 0.01. So you will get 1.12. So that is the answer that we have got. So the basic idea is that the difference between the interest rate is the same as the difference between the forward exchange rate and the spot exchange rate. Okay, so that is the basic idea. Is it clear, Sorish, and anyone that has any doubt in the interest rate parity? So this is a static question, but as the students has asked me, so I am bringing it here so that you have the clarity. And this was a question that was asked in SEBI Grade A. Okay, so forward exchange rate question was asked in SEBI Grade A. So here is the idea that the forward exchange rate, see, simply the forward exchange rate between two countries. Forward exchange rate is the future exchange rate, what you expect, right? So forward exchange rate between two countries is divided by the spot exchange rate is equal to the difference between the interest rate. So interest rate of one country, interest rate of another country. So if right now dollars we are considering is the currency of our country. The dollars we are considering is the currency of our country. Okay, so spot exchange rate, so it is 1.13 dollars for per euro. For 1 euro we are giving 1.13 dollars. And the interest rate of the domestic currency is written here, that is 2%, that is in US, and 3% that is in France, or that is in European Union, let's say. Okay, so the difference between the interest rate, that is 1%, should be the difference between the forward exchange rate and the spot exchange rate, that is of 1%. So forward exchange rate should be 1.12, so that the difference can be same, right? So that is the idea. Any confusion here? Yes, correct, Sorish. So it is equating, so arbitrage do not happen and the speculation do not happen. So that's why the difference between the interest rate in between the countries is equal to the forward exchange rate divided by the spot exchange rate between the countries. So this is what the interest rate parity has said. Okay, so this is a static concept, but this is the brief idea. Now this is the first question. I hope you will be easily able to answer this question. And before going to the second question, let me show you. So this is the website, that is edutap.co.in. So this is the website of our institute, and you can understand that we are providing a lot of free material. We are providing the blogs in which a lot of understanding is provided to you in regards to different segments. That is, if you want to know about the exam information, if you want to know about the job profile, if you want to know about the strategy of the examination for any exam, let's say you want to know about you want to get the understanding in regards to RBI Grade B. So if you want to know about the exam information, the exam analysis, and the level of the examination, the eligibility criteria for the examination, so everything is provided under the exam information. So this is very nicely curated for you to understand about the different segments. So if you want to know about the strategy for the examination, if you want to know the success stories of the different aspirants that have cleared the examination, so you can get it in the blog section. That is free material that is provided to you, and this is for any of the examination that you can get this kind of understanding. Okay, so next, if you want to join the Telegram channel also, so here at the end of the page you can see that there is the Telegram channel that you can join to get the to get the PDFs of the session. Okay, so this is it. So the first question I hope you will be easily able to answer, and this is the second question, again a very easy question for you now. So I hope you will be able to answer this question. Okay, so now before ending this session, another announcement for you all, that we have brought for you this comprehensive guidebook for RBI, NABARD and SEBI, so that through a single guidebooks, so through a single guidebook you can get much of the information regarding the examination and the pattern of the exam, the syllabus of the exam, the previous year question also you can get with this guidebook. And this is absolutely free of cost, to save your time, to save your efforts. So do download the guidebook. The link is provided in the description box below. Okay. No, Mini, it is not compulsory, but if some investee company has issued the equity, in that case, the AIFs can use it as a collateral for the investee company only. Okay. Any confusion, anyone now? In regards to the two news articles, so we have done the two news articles for SEBI. The first one is regarding the certification, and the second one is regarding, the second news article is regarding the AIFs that can do the encumbrance, that can pledge their shares, that can pledge their equity for the investee company. So these are the two things that we have discussed, two news articles that we have discussed today. So I hope it is very much clear to you all. So this is it for today. Thank you very much for joining the session. I hope you liked the session. Okay.